Imagine you check your bank account. You have $5,000 sitting there. It feels solid, earned, stored, real. Now, imagine I tell you that most of that money was never printed, never mined, never physically created at all. It was typed into existence. Not by a hacker, not by a conspiracy, by the normal banking system. And somehow, the world doesn't collapse every time that happens. So what's going on? Right now, governments are running massive deficits. Central banks have expanded their balance sheets into the trillions. Headlines scream about money printing like it's economic arson. And yet, grocery stores still function. Paychecks still clear. The lights are still on. If money can be created out of thin air, why doesn't it cause chaos every single time? Let's slow this down. First, here's the uncomfortable truth. When you deposit $1,000 into a bank, the bank does not put your money in a vault with your name on it. They record it as a liability, and then they lend most of it out. If someone takes a $900 loan from that same bank, the bank doesn't hand them your physical cash. It simply credits their account with $900. That $900 did not exist 5 seconds ago. Now the system shows you $1,000, borrower $900. Total money in the system $1,900 from the original $1,000. That's not a glitch. That's how modern banking works. This is called credit creation, and it's responsible for the vast majority of money in the economy. Physical cash, it's a tiny fraction. In the United States, less than 10% of the money supply is actual paper bills. The rest is digital bank deposits created through lending. So yes, money is mostly created out of thin air. But here's where it gets interesting. Banks can't just type infinite numbers. They're constrained by 3 things: capital requirements, regulation, and demand for loans. A bank must hold a certain amount of capital relative to its assets. If it lends too aggressively and those loans go bad, it can become insolvent. That's how banks fail. And if people or businesses don't want to borrow, money simply doesn't get created. This is why during recessions, even when central banks flood the system with reserves, lending can stall. The pipes are open, but nobody wants to drink. Now, let's zoom out. Where does the central bank come in? When a central bank, like the Federal Reserve, wants to stimulate the economy, it buys assets, usually government bonds, from banks and financial institutions. In exchange, it credits their reserve accounts. Again, numbers typed into existence. After 2008, the Fed's balance sheet exploded from under $1 trillion to over $4 trillion. After 2020, it surged past $8 trillion. Trillions created. People expected hyperinflation, wheelbarrows of cash, economic chaos. It didn't happen. Why? Because creating reserves is not the same as forcing banks to lend, and it's not the same as forcing consumers to spend. Money only causes inflation when it chases real goods and services. If banks hold reserves, if consumers save instead of spend, if businesses don't expand capacity, then the newly created money can sit quietly in the financial system. Think of it like building more roads. If no one drives on them, traffic doesn't increase. But here's the hidden mechanism most people miss. Every dollar created through lending is also a dollar of debt. Money and debt are twins. When the loan is repaid, that money is destroyed, deleted from the system. Creation and destruction. Expansion and contraction. The money supply is constantly breathing. This is why debt levels matter so much. If too many loans go bad at once, money effectively disappears. That's what happened during the 2008 crisis. Credit froze. The money supply contracted. Panic followed. The system didn't collapse because central banks stepped in and replaced vanishing private credit with public liquidity. They didn't save money, they replaced vanishing money. Now here's the irony. People fear money creation, but the bigger risk in modern economies is often money destruction. If banks stop lending and debts are rapidly repaid or defaulted on, the money supply can shrink fast. That's deflation, falling prices, layoffs, bankruptcies. Chaos doesn't come from money being created. It comes from the speed and direction of the shift. Too much money chasing too few goods, inflation. Too little money supporting too much debt, recession. The system works most of the time because it's a balancing act. Banks create money cautiously because they want to be repaid. Borrowers take loans because they expect future income. Central banks adjust interest rates to cool things down or heat them up. It's not magic, it's incentives. But here's the part that should make you slightly uncomfortable. The entire system depends on confidence. Confidence that loans will be repaid. Confidence that banks are solvent. Confidence that the currency will hold value. If that confidence breaks, money created out of thin air suddenly feels exactly like what it is, thin air. And confidence is not printed, it's earned, slowly, and lost quickly. So the next time you hear that trillions were printed, remember this: money is not a physical object, it's a network of promises. And as long as those promises are believed, the system holds. The real question is not whether money is created out of thin air. It's how much of our economy rests on the assumption that tomorrow will look enough like today for those promises to make sense. And what happens the day it doesn't?